Hello, the video you're about to watch is part 2 of a 4-part series discussing what many are calling the new normal in retirement. And for those of you that are interested in a really in-depth study of this, we also put together a 40-minute full presentation that goes over the entire new normal retirement from start to finish. There's a ton of information on it. It's a lot to digest for many people in that 40 minutes. So feel free to enjoy these 4 separate videos on your own time schedule, one at a time. Now let's quickly go over what you're going to learn in this video. In this second video 4, you will learn about one of the most painful issues of the new normal retirement, which is tax rates during retirement. Now, ever since 401ks and IRAs were introduced, Wall Street, politicians, and companies that supported this new change from the pensions to these 401ks and IRAs, they've tried everything imaginable to paint a beautiful picture about 401ks and IRAs, that it's something that could be equivalent or even better to a pension. However, it doesn't take an economist or a rocket scientist to realize that this simply is not the case. And one of the big concerns today regarding qualified plans like your 401k and IRA is what tax bracket will you, the retiree, actually be in when you begin to take withdrawals. The story has always been presented where it's one that you can defer taxes, right, while you are working, unless you're usually in a higher tax bracket. And by the time you retire and begin to take that 100% taxable money out, you should be at a lower tax bracket. Now, however, the original founders of this concept surely never predicted that America would be running a multi-trillion-dollar debt, no less a $16 trillion debt. And sadly, all parties know that increased taxes for all tax brackets, for everyone, it will be an integral part of reducing this nation's debt. No one seems to want to admit it publicly until it happens, but it will happen. So in this video, we're going to discuss the importance of all of these tax issues and concerns. To begin, times have certainly changed in regards to retirement. Gone are the days when you retired with a gold watch and a pension that was guaranteed to last as long as you lived, and perhaps there was still enough left where your spouse could have some lifetime income as well. Yes, unfortunately, those days are long gone. The responsibility of making sure that your retirement funds last as long as you do has been taken away from the company you work for and now rests squarely on your shoulders. Yes, today the responsibility now lies with you as the employee. The transition has gone from those guaranteed pensions to funding your own pension plans like the 401k, the 403b, or even a 457 plan. And some individuals don't even have the luxury of being offered one of these through their employers these days. So they've had to take it upon themselves to open up IRAs to completely self-fund, which is why you see the gentleman sitting there by himself on a chair, to self-fund their retirement plans. And now many economists and speakers around the country are calling this the new normal in retirement. But there are some big potential issues facing us with this new normal for retirement income planning that need to be addressed and examined. And as I mentioned, this is part 2 in a 4-part series, and we will briefly go over issue 2, which are the potential hidden and increased taxes during retirement. But to give you a brief idea of the other main issues we'll be discussing in the series are, number 1, the possibility of outliving your assets, number 3, inflation and how that's going to affect your retirement, and then number 4, the hidden fees in your 401k plans. All of these pose very big threats to the safety and security we should all be striving to achieve, and really what should be the best years of our lives. But for now, let's take a closer look at number 2, taxes, not what you bargained for. Retirement accounts like 401ks and IRAs originated with the concept of withdrawing funds at lower tax rates, as I mentioned earlier. The original concept that qualified plans were based on was to defer all of these taxes while you were working and withdraw funds in retirement when your tax rate would have to be much lower. It sounded simple. However, it doesn't show too much promise for the future, especially if we keep running trillion-dollar deficits each year. Now, whether you want to accept it or not, taxes will undoubtedly go higher due to our huge national debt. And no demographic or class will not feel some effect of this. these higher taxes will inevitably eat into any amount you will need to live on during retirement. Now, our national debt, as you probably know, is over $16 trillion, and it's expected to increase greatly over the next decade. And some contributing factors behind this prediction are, our aging population, incredibly rising healthcare costs, the expansion of the federal subsidies for health insurance, and of course that growing interest payment on our federal debt every year. We are currently paying almost $1 trillion a year in interest alone on the debt we've incurred so far. Now, here's a really startling and scary thought. The Congressional Budget Office, also called the CBO, has reported the prediction that as a nation, we will be paying over $2 trillion in interest alone on the debt we owe annually by 2019. Once again, $2 trillion in interest payments alone on our debt by 2019. Now, since the source of repayment of these debts is through income taxes, the only solution seems to be higher taxes. Now, given our nation's debt and the fiscal uncertainty we are in, it seems pretty clear that tax rates will climb. So, knowing all of this, you have to ask yourselves, should qualified plans be the foundation of your retirement plan? And if they are, what kind of effect will this have on your retirement income? Now, here's a very eye-opening chart. It illustrates the past tax rates from 1913, which was when income taxes were first collected, all the way up to 2012. It also illustrates how and when certain occurrences affected the rates at which we were continued to be taxed. Now, as you can see, as recently as 1963, marginal tax rates were up to 91%. So that means for every dollar that you made, 91 cents of that dollar was going to pay the government. And in 1980, they dropped to 70%. And it wasn't until 1987, which was not that long ago, they dropped to a little lower, below 50%. Now, even with the recent tax rate increase that took effect on January of 2013, our highest tax rate is now 39%. And if you fall into a certain category that pushes you over a certain income level, which, by the way, is lower than the $400,000 plus in income, which this higher tax rate is levied, you can now have an additional 4.7 tax added to your tax bill. Now let's take a look at the next slide to hear about this new tax. Yes, there is a new tax that took effect January 1st of this year that was levied to help fund the new Affordable Health Care Act, some are also calling Obamacare. Now, could this new 2013 Affordable Health Care Act tax affect you this year? Of course. Regardless of Congress passing legislation extending the Bush tax cuts and not going off what was referred to as the fiscal cliff we all keep hearing about, certain taxpayers will be facing a new 3.8% tax assessment on unearned income, as well as an increase in Medicare taxes, which will increase from 1.45% all the way up to 2.35%. Now, this new law does not have the higher income levels that were negotiated for the extension of those particular tax cuts. So what should you do? To begin, have a plan. One of the biggest issues that we see are boomers who simply don't have a plan at all. It would be like thinking it's a good idea not to have a budget for any kind while you're trying to save each year for your new home or your new car or paying for your children's college. Make a plan for retirement and stick with it. Secondly, assuming you have some sort of qualified plan besides a pension, we highly recommend that you speak to licensed professionals about the pros and cons of a Roth IRA. Converting your existing 401k or IRA from a traditional to a Roth, it will not make sense for everyone, but it could make or break your retirement if taxes really do rise like some economists are predicting. And this is, once again, for all tax brackets. Don't think you're not going to be affected by this. Now, and finally, stay educated and up to date on future tax changes, especially those tax ranges around annuities, life insurance, 401ks, and IRAs. And to do that, you can begin by downloading this free report on the serious tax issues in this new normal retirement. It was written exclusively for baby boomers and retirees by a highly sought-after retirement writer and contains some incredible insight and solutions to this potential tax bomb for baby boomers. Find out the retirement secret to saving huge amounts of money in taxes that some of the wealthiest Americans are already starting to take advantage of today. It only takes seconds to download, so don't hesitate. It's yours to keep for free. Now, best of luck in retirement. You have worked hard, and you deserve nothing less.